Asian equities reversed initial loss, boosted by manufacturing data from China. Improvements in risk sentiments helped lift the Aussie, which is additionally supported by stronger than expected inflation reading. Meanwhile, the dollar remains firm against other European majors even though it retreated mildly. Focus will turn to a string of economic data from the Eurozone first, including PMIs and German IFO. Later in the day, the focus will be on US housing data, followed by the Bank of Canada Monetary Policy Report and then the Federal Open Market Committee rate decision and statement. So, be prepared for a rough ride in the markets. The China HSBC flash manufacturing PMI jumped notably from 47.9 to 49.1 in October, hitting a 3-month high. Details were solid with improvements in new orders and export orders while inventories fell. The data argues that the slowdown in the manufacturing sector might have bottomed out already and there will be modest recovery ahead in the coming months. Asian equities opened lower following the sharp 243-point fall in the Dow overnight. But the Chinese data helped turn the Nikkei and Hong Kong HSI back to positive. Though, sentiment seems to have lost momentum as the session went on. Australian CPI rose more than expected by 1.4% quarter-on-quarter and 2% year-on-year in Q3, compared to consensus of 1% quarter-on-quarter and 1.6% year-on-year. The Reserve Bank of Australia trimmed mean CPI rose more than expected to 2.4% year-on-year and the weighted mean CPI jumped to 2.6% year-on-year. While the stronger than expected inflation reading isn't enough to change the Reserve Bank's loosening bias, the data would give the central bank more thoughts before cutting rates again. And that reduced the chance of another cut in November. Bank of England Governor Mervyn King said that he's still concerned if whether some of the recent more positive signs will persist. He noted that storm clouds coming from the euro area have not yet lifted, and China, India and Brazil are slowing. And he pledged that, should those signs fade, the MPC does stand ready to inject more money into the economy. The UK will release first estimate of Q3 GDP data later this week. The October Federal Open Market Committee meeting will likely be an uneventful one. We expect policymakers to leave the Fed funds rate unchanged and make no adjustment on asset purchases. Few adjustments could be seen in the accompanying statement too. However, the December meeting will probably be an interesting one. By that time, Operation Twist will be complete and the new president will be elected. We expect the Fed would expand the size of QE3 from $40 billion per month now to $85 billion per month from January. While there has been much talk about changes of the central bank if the Republican Party wins the election, Fed Chairman Ben Bernanke's Fed chairmanship expires on January 31, 2014, while his term as a governor runs through to 2020. Therefore there should not be a dramatic change in the monetary stance anytime soon.